Hello, my name is Dylan Blackford, and I am here with the rest of the Gulf Island Fabrication Burke and Road report team from Tulane University. The date today is March 23rd, 2011, and we are here to give you a rundown on one of the premier offshore production platform fabricators in the United States. Gulf Island Fabrication began operations in Houma, Louisiana in 1985 as a private company and went public in April of 1997 at $15 per share. The stock currently trades at $32 per share on the Nasdaq exchange and has approximately 14.3 million shares outstanding. Now, I will go into a little more detail about Gulf Island and its operations. Gulf Island is the leading fabricator for the offshore oil and gas industry. The company's primary activity is the fabrication of offshore drilling and production platforms. Gulf Island also has the ability to diversify through its marine fabrication operations. These activities include the fabrication and repair of various marine vessels. Gulf Island derives a great deal of its business from a few large customers. As indicated in the chart, three or fewer customers have represented a significant portion of the company's business over the last 3 years. The chart also shows the company's reliance on repeat customers. The same customers continue to look to Gulf Island for their deepwater fabrication needs. This can be seen as a testament to the quality, service, and reputation of Gulf Island. Gulf Island's peers include McDermott International, Technip, Global Industries, Caldive International, and private company Kiewit Offshore Services. Global Industries is a similar-sized peer that performs platform installation and removal. J. Ray McDermott is a subsidiary of McDermott International that also competes directly with Gulf Island for offshore construction projects. Technip is a French engineering company that provides offshore construction solutions to oil and gas companies around the world. Kiewit Offshore Services is the offshore oil and gas construction branch of the private company Peter Kiewit and Sons. Caldive International is not a direct competitor, but it is a similar-sized peer in the offshore drilling services sector. The table on this slide provides a financial comparison of Gulf Island and its four public peers. Gulf Island is the smallest company based on market cap, but its relatively small size may help the company conduct its operations without undertaking any debt. Gulf Island's peers are highly levered, except McDermott, which could potentially make them a more risky investment than Gulf Island. However, the leverage also lowers their cost of capital. Gulf Island is currently declaring dividends, albeit at only a 0.76% yield, despite the recession, unlike its three domestic peers, McDermott, Caldive, and Global. Now, Ryan Didion will talk about the risks Gulf Island faces.
Hey, this is Ryan. Cyclical risk for the oil and gas industry is the largest risk that Gulf Island must face. The company has some measures to combat its susceptibility to cyclical risk, but by expanding its marine fabrication and repair business. Marine projects currently take up more than 20% of revenue backlog. Management at Gulf Island plans to continue building up its marine business to help eliminate some of the cyclical risk. A lack of geographical diversification due to high transportation costs also makes Gulf Island susceptible to cyclical risk. The market sentiment in deep water oil and gas exploration and production across the U.S., and especially in the Gulf, is one of uncertainty because of the resistance from federal departments to approve new deep water permits. However, on February 28th, positive news for the industry was released when Noble Energy was awarded the first deep water permit since the BP Deepwater Horizon incident. Two more deep water permits have since been granted. And now I'd like to talk to you about the Z-score. The Altman Z-score is an indicator of the company's financial health and attempts to predict whether or not the company is likely to go into bankruptcy within the next 2 years. This model considers the company with a Z-score greater than 2.99 to be in the safe zone, those between 1.8 and 2.99 in a gray zone, and those below 1.8 in a distress zone. Gulf Island's Z-score has been in the safe zone for the past 3 years. Now Eric Ring will talk a little bit more about Gulf Island's recent developments.
Gulf Island's revenue backlog as of December 31st, 2010 is $486.1 million, which is up 3.5 times over the revenue backlog as at December 31st, 2009 at $136.8 million. On December 23rd, 2010, Gulf Island signed a contract to fabricate and integrate the topsides on a deepwater project in the Gulf of Mexico. Although Gulf Island has not yet released the customer on or all the details of the contract, it accounts for 64.1% of the company's backlog as of the release of the 2010 10K. On February 24, 2011, the company increased dividends from 1 cent to 6 cents per share on a quarterly basis. This is a very positive signal as Gulf Island paid a 10-cent quarterly dividend as recently as the fourth quarter of 2008, and we expect the company to reach this level again by mid-2012. We arrived at a 12-month target price of $34.10 using 4 valuation methods: discounted cash flow, price to earnings, price to book value, and enterprise value to EBITDA. We consider discounted cash flow very important because it uses internal variables, including net capital expenditures, and also because Gulf Island's similar peers are not perfect matches. We found EV to EBITDA also important because enterprise value is a stronger measure of the overall value of a company than just looking at market cap, and because EBITDA is much harder to manipulate than earnings per share. We use price to book value because we felt recent earnings have been somewhat skewed by the recession and the Deepwater moratorium. Book value gives us an internal value that is not as strongly affected by external factors as EPS. We also use the PE method because even though recent earnings in the industry have been strongly affected by the recession and moratorium, we believe this industry will still be affected by these events over the next year, but to a lesser extent. With the current price at $32, we get about a 7.3% forecasted total return. This return brings us to a market perform rating. A few points we felt were important about the company over the next 12 months. The current record high backlog above $480 million provides a positive outlook for next year. Gulf Island's clean balance sheet and record high cash balance of nearly $90 million offer stability and flexibility. The political and regulatory environment creates uncertainty for deepwater drilling. Rising oil prices are causing pressure on the Department of the Interior to push through more deepwater permits. Gulf Island's deepwater expertise and increasing diversification from the Marine Building Division are positive indicators for 2011. On Friday, March 18th of 2011, the Gulf Island team of 5 analysts and our investment research manager arrived at Gulf Island's headquarters in Houma, Louisiana. We were greeted and directed to a conference room where CEO Kerry Chauvin and CFO Robin Seipert greeted the team and had a prepared quick presentation for us. After the presentation, Mr. Chauvin and Mr. Seipert allowed us to ply them with questions through the afternoon. After lunch, we received hard hats and safety glasses, and Mr. Seipert took us on a personal tour of the fabrication yard and facilities. The tour was of the East Fabrication Yard that had numerous ongoing marine fabrication and restoration projects. We were extremely impressed with the efficiency, safety, and high-tech equipment on the yard. The Bergen Road reports are produced solely as part of an educational program at Tulane University's Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.